Look at this map of North American energy. Canada has operated as a massive energy generator with a single dominant customer. Oil, natural gas, and electricity almost exclusively traveled south. Historically, 96% of Canadian crude oil exports fed the American industrial base. This design was the product of decades of bilateral integration. It was a highly efficient system built on physical infrastructure and a long history of cross-border trade cooperation. But wiring an entire export economy to a single destination creates a structural liability. By locking its resources into a continental loop, Canada engineered a captive market, losing the ability to price its resources against global benchmarks. Ultimately, geography and infrastructure combined to tether Canada's national economic security to the shifting political priorities in Washington. That relationship faced a sudden shock in early 2025. A massive trade war introduced external pressure directly onto this captive energy loop. The policy included 25% blanket tariffs on most imports, paired with targeted 10% tariffs specifically aimed at Canadian energy products. The map shows the immediate physical impact. The steady southward flow of energy hits an artificial wall. With the border choked, energy began to pool up inside Canada, threatening a severe domestic economic contraction. While the public conversation focused on diplomatic retaliations, a structural shift was already being activated. Canada began accelerating the completion of physical routes that could bypass the U.S. border entirely. Leverage in a trade dispute requires the target to have no alternatives. Canada's response was to build those alternatives as permanent physical infrastructure. The Trans Mountain Expansion, or TMX, functioned as the first major release valve for this trapped energy. The upgrade nearly tripled capacity to 890,000 barrels per day. For the first time, Alberta's oil had a massive, permanent path through the Rocky Mountains to the Pacific coast. Simultaneously, new Pacific terminals began shipping liquid natural gas. These facilities allow gas to be compressed and loaded onto tankers, moving it off the continental pipeline grid and onto the open ocean. These exports target industrializing nations like India and Japan. For these buyers, Canada offers a rare combination: vast energy reserves from a stable, predictable democracy. By turning its infrastructure west, Canada converted its energy from a captive continental commodity into a globally traded asset. While the Pacific strategy focuses on tanker shipments, a stealthier structural move is happening in Europe. Canadian companies bypass the standard export model by directly acquiring European pipeline grids, specifically the Dutch North Sea infrastructure. Owning the physical delivery mechanism inside a foreign continent provides a level of influence that transactional fuel exports cannot match. It integrates Canadian interests directly into the daily energy flow of several neighboring countries. Controlling this infrastructure positions Canada to help set the standards for Europe's future energy transition, including the transport of hydrogen and carbon capture networks. This strategy creates long-term geopolitical leverage by securing a permanent role in the actual wiring of the European energy market. The newest form of Canadian energy infrastructure bypasses tankers and pipelines entirely by focusing on the high-speed transmission of virtual power. The foundation of this shift is the Canadian electricity grid. It is already heavily decarbonized, anchored by immense baseline hydroelectric resources. Instead of exporting raw electricity south, Canada redirects power domestically into massive AI data centers. These facilities convert electricity into processed AI data, exported globally via telecom fiber at the speed of light, a zero-emission export physical tariffs cannot touch. In the 21st century, hosting the compute economy has become a high-value form of energy leverage, converting domestic power into borderless digital infrastructure. Look at the total system upgrade. Canada has physically evolved from a north-south tributary into a multi-directional global energy hub. The United States remains a crucial integrated partner, but it is now one customer in a diversified and more resilient portfolio. This permanent, highly advanced physical and digital infrastructure significantly reduces the risk of unilateral trade blockades or sudden political pressure. The physical and digital rewiring of its resource flow allowed Canada to navigate a trade war while establishing itself as a flexible, multi-directional participant in the global energy market.